Price is what you pay, value is what you get. Okay, now let's talk about price and value. Both price and value are the two sides of the same coin. Understanding the difference between price and value is important because it helps you sort out good investments from bad investments. So I want you to take a quick note here. Price and value are not always the same. You know, most inexperienced investors look at a stock's price to determine if it's cheap or expensive. They think that a $5 stock is cheaper than a $50 stock. Well, it seems cheaper because of the price tag. But they don't know that their $5 stock may be only worth $2 or $3, for example, while the $50 stock can be worth over $80 or maybe $100. So that's the difference between price and value. You know, looking at the price side is not investing. It's gambling because you have no idea about how much your stock is actually worth. Only considering the market price is the same as you go shopping. You buy a product because the shop tells you that there's a promotion. They discount the product and you feel you're buying something cheap. But the thing is, even with a discount, that shop can still make a profit because they're selling you a product at a price that's higher than its cost of production, so that product is overvalued. The same for the stock market. As a value investor, we need to look at the value side. So before making your investment in a company, you need to make sure that you'll only buy it when it's undervalued. There are three types of value that you need to know about if you want to be successful as a value investor. Evaluating these values carefully will show you a clear picture of how profitable a potential investment is. The first is relative value. The second is absolute value. And the third is perceived value. Now, let's dive into each of them in turn. Relative value can be determined by comparing a company's financial performance with that of its competitors within the same industry, and also with the industry average. The differences between a company with its rivals tells you exactly how well it's operating and generating profits. When a company is profitable and able to operate efficiently, that will make a significant contribution to its shareholders' value. This simply means the more profitable the company is, the more profitable you are as a shareholder. So to determine relative value, the easiest method you can use is performing a financial ratio analysis. We'll simply compare a company's profitability, efficiency, liquidity, and solvency ratios with that of its competitors and the industry average. The company with the best ratio values will be the best company in the industry, and it's a worthwhile investment in terms of its relative value. Financial ratio analysis is a big topic in value investing, so I'll teach you how to use financial ratios the right way in another course. But right now, you just need to know that it exists, and you'll need to learn about it later to master your value investing skills. Okay, the second value that we're going to talk about is the absolute value. In short, it's the company's intrinsic or real value. You'll need to perform a stock valuation to estimate your company's intrinsic value. Then compare its value with the current market price. If the intrinsic value is higher than the current market price, or the company's stock is selling at a price which is cheaper than it's actually worth, this means it's undervalued or cheap to buy. So, we'll consider buying it to make a profit when the price increases in the future. And on the other hand, if the intrinsic value is lower than the current market price, the stock is overvalued or expensive. We simply avoid buying this company's stock. So to determine absolute value, we'll use some valuation methods such as the discounted cash flow model or dividend discount model. Okay, the final one is the perceived value. Perceived value is the price that people are willing to pay for a product or service. And in the stock market game, it's the price that people are willing to pay for a share of a company. The perceived value is completely unrelated to the absolute value. The best example of perceived value is this picture. It's actually worth maybe just a few $100s to pay an artist to paint it. But guess what? It's worth millions of dollars. Why? Because there are people who are willing to pay that high price to own this picture. The selling price will totally depend on the perception of the buyers. And I want you to know this. The stock market also works on the perceived value, and the stock price of a company reflects the perception of investors like yourself. You can easily see perceived value in growth stocks, where companies are growing much faster than their competitors and the whole industry. So that's why investors are ready to take higher risks and pay a higher price for owning those stocks. And to determine the perceived value of a company, you'll need to do a qualitative research. You'll need to find out what people think about that company, how skillful and experienced its management is in growing their business, what the values are that the company brings to the world. And the only way to know this is spending a lot of time reading news, stock analyses, and customer reviews. In the next lecture, we'll talk about another important topic of value investing. That's the margin of safety, one of the most critical factors that will determine your value investing success. Okay, see you in the next video. In this video, we're going to talk about the margin of safety and how you can use it effectively to reduce risks on your investment and make a wiser investment decision. So what exactly is margin of safety? Margin of safety is simply the difference between the intrinsic value of a stock and its market price. For example, the market price of a stock is $6 a share. You find that its intrinsic value is about $10 a share. So in this case, we have a margin of safety of $4, or 40%. In fact, the higher the margin of safety, the lower the risk on your investments. The margin of safety is achieved when a stock is bought at a price which is sufficiently below underlying value to allow for human error, bad luck, or extreme volatility in a complex, unpredictable, and rapidly changing world. Or in other words, using a margin of safety will allow you to correct your mistakes in your investment analysis and valuation. Well, when it comes to stock valuation, we make mistakes all the time. Every valuation method is implemented based on assumptions. For example, when using the discounted cash flow model, you'll have to assume that a company's cash flow will grow at a consistent rate over the next 5 to 10 years. What will happen if its cash flow grows by 10% this year, 5% next year, and negative 8% in another year? You see, our valuation method is somewhat biased, and that's why the margin of safety concept is applied to value investing. So how much margin is acceptable? Well, it depends on how much bad luck you're willing to face, your risk tolerance, and how much money you can afford to lose. Losing some money is an inevitable part of investing. In fact, there's nothing you can do to prevent it. But to be a sensible and intelligent investor, you must take responsibility for ensuring that you never lose most or all of your money. If you think you can't afford to lose much from your stocks, it always pays to have a good margin of safety, say around 30 to 40%. This means that you must buy a $10 stock for not more than $6 or $7. Remember, the higher the margin of safety, the better. And also make sure that you will always use a margin of safety of at least 25% for the sake of your money's safety. In the next module, we'll dive into some investing principles that you should always keep in mind when investing in the stock market. Okay, see you in the next video.
Thank you for watching, and let us know your thoughts in the comments below. Check out the offers in the description for more surprises. Please make sure you give this video a thumbs up and subscribe to our channel. Don't forget to check out more exciting videos in our channel.